Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can understand not only how we're currently positioned, but also what we see in the global landscape around the world. You know, the U.S. marketplace in general, retail sales, housing, autos, are getting just a little bit better. Of course, never as fast as anybody would like, but generally speaking, the economy is slowly getting better. We're seeing kind of what I call the old stealth rally, meaning a lot of negativity out there in the world about fiscal cliffs, obviously, in 2012. We're talking about sequestration now. There's always going to be something that somebody's going to worry about, or what we call the talking heads on like a CNBC. At the end of the day, everybody's got an opinion, but it's really the direction of where the economy is headed and any investment sector. And remember, investment sectors are not just the stock market. They can really be anything from oil, gold, silver, currencies, inverse ETFs, of course, emerging markets, and so on. But I think too many people focus on just one place, which is the U.S. If I look abroad, of course, Europe continues to be in a mess. They're repairing themselves. It's going to take a long, long time. And those are areas, obviously, that you probably want to look to avoid, generally speaking, in many of the countries. Italy's come back in the limelight again with their elections. Again, I think it's a moot point. At the end of the day, run a strict investment strategy. Look for areas that are relatively strong, which is exactly what we do. Those areas that are relatively strong historically over periods of time have shown to outperform. And also, more importantly, reduce risk. I believe that you're going to see the interest rates on the long bond continue to stay fairly stable, about a half a point higher than we saw about 6 months ago, but fairly stable. Ben Bernanke's testimony with Congress, of course, has been pretty much, hey, we're going to keep doing our bond buying program. We're not seeing the real growth of unemployment growing as fast as we want, or employment growth, so they're going to continue their program. This will basically help, in my personal opinion, put a floor on really major declines in any investment sector, primarily in the equity-based side. Now, when we look at the bond side, traditional bonds, mid-cap and long-term bonds are continue to be the most volatile, in my personal opinion, and the most overvalued sectors, generally speaking, across the global landscape. If I look at how a lot of investors have invested that are coming into our offices, if I look at or listen to the calls that come in from my TV or radio show, we continue to see people who have just piled tons of money into long-term or intermediate-term bonds or bond funds. And unfortunately, what they're starting to see is the safety net they thought that bonds actually give is not a safety net at all. In fact, when rates are as low as they are, bonds, in my personal opinion, will be as volatile or 50% more volatile over the next 3 to 5 years, I believe, than what equities are going to be. Again, the long-term bond duration gives you more volatility up and down. It's like a teeter-totter when interest rates move up or down. So with rates being as low as they are, and probably not seeing a lot of interest rate decrease or more decreases substantially from the Federal Reserve, I think you're going to see rates stay similar where they're at. If we get a little bit more traction over the next year or so, I think rates will slowly tick up. But again, even FINRA, who governs the broker-dealer side of the business, has now warned investors. They've joined the parade, essentially, telling investors, hey, intermediate and long-term bonds have substantial risk. They can go down when interest rates go up. Statistically speaking, an average 10-year maturity bond mutual fund that has an average 10-year duration or bond in that portfolio will go down about 10% when rates go up just 1%. Of course, if you own a 15 or 20-year-old long maturity bond or bond fund, your decline can be substantially bigger. So these are the warnings that we've given out repeatedly to investors. What a lot of people perceive to be safe, which is bonds or bond funds, ultimately I believe will be riskier than the equity-based market, with very little income potential and very little upside at all. I see a lot of downside, and I see very little upside, and I see very low interest rates on traditional types of fixed income. Right now, I think investors need to look across the income spectrum for alternative income asset classes, not just stocks, not just bonds, or not just bonds in the U.S. to provide income, but look at things like publicly traded REITs, royalty trust, master limited partnerships are another one. Look at emerging market equities or emerging market bonds in addition. I think too many investors think the only place to invest in bonds is in the U.S. and corporates or in munis or in U.S. treasuries. And again, muni bonds specifically in the U.S. and government treasuries, in my personal opinion, are the two most overvalued areas an investor could be in right now. Of course, we don't own any of these, and I would be a net seller of any long-term bond or bond fund, specifically munis and government type treasuries. We're going to have a live TV show tonight, of course, and we'll have a live radio show on Sunday. If you're a client and you have questions about your portfolio, please give our office a call. If you're not a client and want to become a client, we always like taking on nice people who want to improve their portfolio. Call our office for a consultation. There is a difference. We do invite you to experience it. Have yourself a safe and profitable week.